Welcome back to the Investing on the Go podcast, brought to you by FundCalibre. Over the next 2 episodes, we'll be focusing on the UK stock market and the opportunities for investors. But we start overseas with the impact of Silicon Valley Bank's failure and what it means for some of the UK's most creative companies and why valuations look good for UK firms.
I'm Chris Sarley, and today we're joined by Alexandra Jackson, manager of the elite-rated Rathbone UK Opportunities Fund. Alexandra, once again, thank you for joining us and spending some time with us today.
Hi, Chris. Thanks for having me.
I know all things UK are on the radar, but maybe let's start with overseas and what's happening with Silicon Valley Bank in the US. Obviously, thousands of miles away, but the bank's been used by a lot of sort of UK tech companies. Maybe just give us a brief overview of what's happened and, how higher interest rates and a sort of lower growth environment might impact some of the UK's sort of most creative companies. And, is it as worrying and sort of the fear of contagion? We've had this before. Should we be as worried this time?
I think it's a really good point. As you say, it is miles and miles away, but there is definitely some second round impacts that we need to think about in the UK. I don't think this is a sort of systematic issue that we need to get extremely nervous about because of the way that the Fed has reacted and because of the signs that I've seen in bank lending since. But, Silicon Valley had a very impressive Rolodex of relationships with those US tech firms, but also a lot of UK tech firms, as you say. And, during that era of very low interest rates, those sort of tech startups, they increasingly banked with Silicon Valley Bank. So SVB was taking a big share of those deposits and those loans, and they were attracting more deposits, than they could loan out. But those deposits weren't particularly sticky because they are effectively current accounts for very cash-hungry, loss-making startups. So you've got short deposits on one side, and then the assets that they had on the other side of the balance sheet were very long duration bonds. So this is basically an asset liability mismatch. This is banking 101. And then the catalyst for things going wrong, of course, was when short rates started rising, and long rates didn't really move. So SVB was, very long duration during one of the most violent yield curve inversions we've ever seen. So you get huge losses, and then a depositor base, which gradually and then very suddenly noticed that A, they could get a much better rate on their money somewhere else, and B, was able to pull their money just with a very quick swipe on the app. But what we've been looking at is, it wasn't the asset quality that was the problem. And it wasn't the quality of the loan book that was the problem. It was just a simple case of balance sheet mismanagement. And sort of in a funny way, that's a bit reassuring because I think that demonstrates that it's idiosyncratic rather than systemic credit issues, which is the sort of muscle memory that I think investors who were around in 07-08 are feeling kicking in. But the other positive signal was the speed and the surety with which the Fed acted to protect depositors, to prevent a run on the bank, and then to sell the bank to another, find it another home. But as you say, the second order impact is this. Is what happens to earlier stage creative companies. So, higher interest rates, that's one thing. The availability of credit is the other important thing. And there's been a lot written about banks tightening their lending from here, which makes sense. But we haven't actually seen any sign of it happening yet. So the numbers that we see, the data has not suggested that it's happening. Actually, banks seem keen to continue lending to their quality credits. And I think that's quite important. They will be looking at all of the fundamentals within a business to keep lending there. So I think we need to wait longer, of course, to see how it pans out. But the signs so far are that quality credits will still be able to borrow money. I spoke to the CEO of one of our portfolio holdings just after SVB. SVB UK was taken over by HSBC. Molten Ventures, a company we own. It's a UK-listed venture capital firm, and they have stakes in around 70 private early-stage consumer tech businesses. So, right in the eye of the storm. And their view is that there will be more strain in this kind of startup part of the market, and that some business models really only worked because of the era of free money. but the companies that that they invested in their core portfolio, they are fully funded for 18 months, so they don't need any more cash in order to realize their growth forecasts. And actually they're growing very rapidly as well, like really rapidly, kind of 60% plus a year, some of these companies. So they're not really the areas that you'd be worried about, but nonetheless, Molten have been asking their businesses to cut their costs where they can, to reduce that that cash burn, so that they're double sure that they don't need extra cash, but without harming the long-term growth, obviously. And actually what he said was that the end of free money, it kind of raises the bar for success. So weaker players will fall by the wayside and the strong will get stronger. He thinks that plays to his portfolio. I know that it definitely plays into our investment style, which focuses on high quality category leaders, best in class.
Well, let's push on that then, because obviously I read a commentary from you. I think it was from for January the 1st. I think it was, and basically where you sort of said 2023 would be a year we'd start to feel the chill from monetary policy. Is sort of dispersion on the table? I mean, you sort of said it was not the classic sort of setup for equities. Is it a case of now is the time to spot some of the stronger from the weaker firms? And in that scenario, does the UK stand out from maybe some of its peers overseas?
Yeah, I think that's exactly right. This should be a really good time for stock picking, and valuation will be the key. When you get this very rapid tightening cycle, strange things happen, like crypto frauds and bank runs and things like that. But more prosaic things happen as well, like companies have to spend more money paying their interest bill, obviously. Funding might not be as plentiful. We've had supply chain issues, labor shortages, all of those things, which mean companies potentially have to downgrade their revenue and profit expectations. And when you get downgrades, valuation becomes essential, because for share prices to move forward, you need to be in areas that have already priced that in. And actually the UK does score really well there. So I think it's the cheapest developed market out there. The UK trades on around a 40% discount to global equities. Now, we've been saying that the UK's cheap for a while. It is usually cheaper than the US. So we have to just kind of get used to the UK trading on a discount to the US. But this the discount now is so wide; it's never been this wide. The S&P 500, for example, sits on 18 times, and in reality, obviously, that number is actually higher because there are some downgrades to come.
And it's a lot more than just the fact that the US is a sort of growth-orientated economy. It's a lot more than just that, isn't it? It's the uncertainty of other things over the UK as well.
Yeah, exactly. But, the UK trading on kind of 10, 11, 12 times, that's pricing in a good deal of those issues already. Mm-hmm. And I think that's quite a nice starting point. It's a good, you really need that margin of safety when downgrades are in the post, when you have that uncertainty.
A lot of the stuff you read is sort of, almost chasing shadows. You're trying to figure out how far the market's going to fall before you perhaps jump in and sort of take an opportunity. Not that's necessarily the way to invest it. At the moment for you, do you look at the market and go, I might have to do this if we have a recession, and then what type of recession will it be, soft landing or not? How do you approach that? And does the environment sort of lean itself to certain sectors, or is it purely company by company?
Yeah, for us, it's always company by company, because, we own sort of 50 to 60 companies only. So we don't need to own anything in any sector. We don't need to own any sector if we don't want to. For example, we don't own any banks at all. So that's sort of, that's quite a nice place to start. So it is always quite bottom up. I guess what we see is that, when you have environments like this, and you don't get kind of downgrades across the market very often. That's quite a peculiar set of circumstances. And they're quite rare. But what we've observed is that during those periods, the areas that outperform, it's actually very consistent, and it is always quality. So, what do people mean by quality? It's return metrics. So return on invested capital, cash flow returns, that any of those kind of return metrics.
Just to be clear for sort of listeners as well, when you say quality, we're not talking about size here. That can be any type of company across the spectrum in terms of quality, can't it?
Absolutely. Small companies can be, very high quality, and, can definitely be higher quality than some large companies, for sure. It's around, how high is the it's a combination of margin and how quickly they turn their assets. It's also, for us, there's a lot in there around the sort of stability of revenues and profits. So you don't necessarily want something that's up a huge amount one year and then down a huge amount. That's not what we mean by quality and reliability. So it's that kind of recurring, reliable, those sorts of factors tend to outperform very, very consistently. And the UK is quite mixed, I would say, on that front. We've got a lot of energy companies, banks. They don't really fit a lot of those sort of classic quality markers. So you have to be quite selective. And actually, to your point, you have to be willing to go down the market cap scale a little bit because, actually, a lot of the quality compounders are, sit in the FTSE 250.
Well, obviously, that brings us on nicely to the portfolio, because obviously you've got a decent chunk invested in the FTSE 250 and also in AIM listed companies. Maybe let's take each one in turn. I mean, are the clouds lifting for FTSE, with the FTSE 250 for these mid cap companies? Are there still stresses? How do you view that? And then maybe let's talk a bit about AIM as well.
Yeah, sure. So I think a lot of the headwinds that really weighed on the FTSE 250 last year, I can see them lifting or maybe even reversing. So weirdly, politics has been one of the sort of strongest upside surprises in recent months, which I didn't imagine that I would be saying. That's not what we're used to in the UK, that's for sure. Obviously, it was a low, it sort of improved off a very low base in October, but the current government has actually achieved some things around the Windsor framework. We might even get a public sector wage settlement, drama-free budget. Yes, these are things we should be able to expect, but we haven't. We haven't had them sort of successively in recent times. So expectations have been so low. So even a vaguely competent government seems to be an upside surprise. And then you've got gas prices which are down below levels they were before when Russia invaded Ukraine. So that's a really nice boon for consumers and for businesses. It means hopefully that inflation has peaked and therefore interest rates are probably pretty close to peaking. And we've seen sterling also reflect a lot of those headwinds dying away, and sterling has bounced really nicely. So, and those are all really good predictors of mid-cap outperformance.
Is there maybe an example of a mid-cap that you would like to sort of highlight that sort of falls into the bucket for your portfolio?
Yeah, absolutely. Keywords Studios is a really interesting mid-cap, UK mid-cap. They are a video game outsourcing business. So we really like the video game space, but I'm never sure exactly which game is going to do best and exactly which console, which area, which niche. So it's a bit like buying a fashion brand. You don't know exactly which are the most successful. So I would rather go one stage back and buy the sort of outsourcer. So Keywords does game design, game support, game translation, all of those things for almost all the AAA manufacturers. Really interesting. Yeah, sorry.
And I was just going to ask, in terms of AIM, is there anything you can do differently? Are you having to maybe meet management a bit more to sort of really get under the bonnet, even perhaps more so in this environment? How does that perhaps work? Because of the liquidity, perhaps the issues that are attached to that part of the market?
Yeah, I think for us, it's just raising the bar again in terms of the quality, the accounting focus. We just have to be stricter, more and more strict all the time, about finding those signposts in the accounts that suggest that all is not what it seems. And it's usually around the same things. It's cash, it's accruals, it's working capital. So it is possible to spot, but I think it's not being done all the time. So we just have to raise the bar. We also raise we've kind of raised the size limit a little bit in AIM, and that seems to help a bit. But what we have seen, our AIM weighting has come down a lot in recent years, partly because a few things have been taken out, been bid for, a couple of things we've sold, and then lots of companies are moving from AIM to the main list, which is an interesting little development. For years, having said, there's nothing wrong with AIM, we're happy here. Actually, now people are saying, we need to demonstrate that we have the most stringent corporate governance and accounting and all of those factors. And one way to demonstrate that is to move on to the main list.
Okay. I'm going to hop across the Atlantic back to the US again. I mean, you've talked recently about UK companies that can benefit from US infrastructure spending. Maybe tell us a bit more about that.
Yeah, that's a really interesting theme running through the portfolio at the moment, actually, with, and it's not just the Inflation Reduction Act, the IRA, it's more, it's also the CHIPS Act, the Jobs Act. A lot of stimulus around infrastructure spending is percolating through the US economy. And it's actually, it's being translated into actual dollars on the ground now, which is something I think people often worry about with infrastructure spend, that you actually never see the dollars. The companies never really benefit from it. Actually, it's happening now. So companies that we invest in, like Ashtead and CRH, which are both in the FTSE 100, and then Hill & Smith also, which is a FTSE 250 business. And they are variously involved in different parts of the infrastructure space. So CRH is sort of aggregates and cement. So very, at the very beginning of, building roads and bridges and things like that. Hill & Smith, they galvanize steel. So they would be more involved towards the end of building a bridge or something like that. And then Ashtead rents out the equipment that you need during that whole process. So all three companies benefiting, at slightly different points of that cycle, and talking very, very favorably about the outlook for spend there.
Okay. I just wanted to sort of round off with a bit of a rallying cry for UK equities. Obviously, it's best part of 7 years since Brexit. Now there's been so much uncertainty for so long that if you'd invested 7 years ago, you'd be wondering what's going on. Maybe give us your view for UK investors and why now might be an extremely good time to go into UK equities, and just give them a sort of bit of reassurance for the market.
Well, I think it's a mixture of that valuation point. So you've got this, you've got this great margin of safety, this great cushion that means we can absorb some of these downgrades. I thought it was really interesting during February when the US market actually sold off because of all these, concerns about a harder landing and recession and whatnot. Investors started worrying about that again. And during that time period, actually, the UK market was up a little bit. So, this is not huge numbers and they're not super long term, but I think that's a good pointer for how this year could potentially play out. So valuation is the first thing. And then it's those, those headwinds disappearing around, politics, interest rates, sterling weakness, some of those things lifting. And the stock market is not the same as the UK economy. So if you can stay active and be quite selective in the names that you own. For me, if you can, really focus in mid caps, which is where the alpha comes from. If you want to outperform in UK assets, you need to own FTSE 250 businesses, not just the FTSE 100. And if you can stay in quality, to try and outrun some of those sort of potholes that can impact performance.
Is there an element? I mean, I know we don't want to use the old saying of past performance. It's not a guide to future performance. But if there is a recession, these type of companies in the mid and small cap space tend to be the ones that lead recoveries as well.
Yeah, they lead it. They lead it out exactly. They've got some. They've got interest rate sensitivity. They've got domestic sensitivity. All of those things. But with that extra, hopefully with that extra quality filter, so that you're not surprised.
Okay. Alex, thank you once again for spending some time with us.
Thanks, Chris.
Rathbone UK Opportunities is a flexible fund targeting quality growth businesses. Alexandra looks to take advantage of cheap UK valuations, but avoids the ex-growth large-cap dinosaurs. She combines structural winners with a strong core of high-quality compounders, and the final portfolio consists of around 50 to 60 holdings with a bias to medium-sized companies. To learn more about the Rathbone UK Opportunities Fund, visit FundCalibre.com. And don't forget to subscribe to the Investing on the Go podcast, available wherever you get your podcasts. Please remember, we've been discussing individual companies to bring investing to life for you. It's not a recommendation to buy or sell. The fund may or may not still hold these companies at the time of listening. Elite ratings are based on FundCalibre's research methodology and are the opinion of FundCalibre's research team only.